Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's get into this. It's a gripping and honestly a cautionary tale from Gregory Curtis's book, Family Capital. It's all about how one family fortune was built, and then, in a single, catastrophic decision, was just tragically lost.
You know, you've probably heard that old saying, right? Shirt sleeves to shirt sleeves in 3 generations. It really gets at this deep-seated fear that the wealthy have, that the fortune the first generation builds is just going to be squandered by the third. And you know what? It happens way more often than you'd think.
I mean, if you look at the numbers, most families just don't escape this trap. But the story we're talking about today is about a family that seemed absolutely destined to be the exception to the rule, the Titans.
So, George saw himself as this really savvy investor. He'd been stewarding the family's capital for decades and things had gone well. But as the author points out, he was making a classic mistake, confusing brilliance with a bull market. It's that trap where you think you're a genius, but really, you've just been lucky.
But then, the market turned, and George's confidence, not to mention his family's entire fortune, was about to be put to the test in one of the absolute worst bear markets in history.
So starting in January of '73, what had been this booming market just started to take a nosedive. It was relentless, and all those investors who thought the good times would never end, well, they were in for a really rude awakening.
Over almost 2 years, the market plunged a staggering 45%. And get this, that's before you even account for the double-digit inflation that was just eating away at everybody's buying power. It was an absolute perfect storm.
As the losses kept piling up, George started to panic. His advisors are telling him, hey, stay patient, average down, but he's not hearing it. He saw their advice as just incompetence. He was totally convinced they were on autopilot while his family's legacy was literally burning to the ground. This is that moment where logic and discipline just get thrown out the window. So in the summer of 1974, with the market still in free fall, George makes a decision that will change everything. He calls a secret family meeting to announce this radical plan that he believed was going to save them all from ruin.
Can you imagine? He stands up in front of his entire family and drops this bombshell. He's selling everything, every single stock they own. But he was adamant this was not a panic move.
He insists, look, this isn't some foolish emotional reaction. No, he needed them to believe that this was about something much, much bigger. He comes up with this grand, incredibly pessimistic theory: America itself was in a terminal decline. He wasn't just making a market call, he was calling the end of an era. And he came with his evidence. He painted this incredibly bleak picture, pointing to everything from political scandals and losing a war to economic rot. He spun this powerful, compelling story of decline, a story that, in that moment of fear, just felt more true than any long-term data ever could.
And that was his closing argument. It framed the whole thing, not as a financial decision, but as this sad, necessary response to the fall of an empire. It was dramatic, it was sweeping, and man, was it convincing.
Now, here's the part that gets me. His family was completely sold. They didn't push back, they didn't ask hard questions, they stood up and gave him a standing ovation for this catastrophic decision. It just goes to show you the power of a good story, especially one that taps into our deepest fears.
So that standing ovation, well, the consequences for the Titan family were, let's just say, swift and absolutely brutal.
They did it. They followed through on the plan, sold everything, and in doing so, they locked in those massive losses at what would turn out to be the worst possible moment in modern history.
And here's the tragic irony of it all. The market hit its absolute bottom almost to the day that they sold, and what came next was one of the greatest, longest bull markets in history. They missed the whole thing.
And the result of this one decision was this stark, painful split in the family's destiny. George's branch, the one that panicked, became known as the poor Titans. Meanwhile, the other branch, which just stayed invested, they thrived. They grew their wealth for generations to come. So, the big question is, how did this happen? How did it go so wrong? Understanding the specific mistakes here is so important because they hold lessons for every single one of us, whether you're managing a family fortune or just your own 401k.
Well, the author boils it down to 4 critical errors. First, George just failed to learn. He never educated himself on investing, which left him totally vulnerable. Second, he had the wrong advisor, a big bank that was full of conflicts of interest. Third, because of that, he was always being sold things instead of thoughtfully buying investments. And finally, the ultimate sin, abandoning equities. He sold the single greatest engine of long-term wealth creation at the absolute bottom.
That whole wrong advisor point brings us to a concept that everyone, and I mean everyone, should know: fiduciary duty. It's a legal standard that means your advisor has to act in your best financial interest, not their own. It is the gold standard.
See, George's bank operated under a much looser standard called suitability, and that just meant they could sell him products that were suitable for a rich guy, even if those products made the bank a ton of money in commissions and weren't actually the best option for the Titans. It's a huge, huge difference.
You know, at the end of the day, this story is such a powerful reminder that the biggest risks in investing aren't always what the market is doing. So often, the biggest danger is right here, in our own heads. George Titan didn't lose his fortune to a bear market. He lost it to a really convincing story he told himself when he was terrified.
And that leaves us with a really critical question to ask ourselves, and not just about our money, but about our lives. What compelling story are you telling yourself right now? And is it leading you toward wisdom, or is it leading you away from it?
All right, today we're digging into what has to be one of the most powerful case studies in all of finance. It's a story about wealth, sure, but it's really about psychology and about one single catastrophic mistake that just completely wiped out a fortune that took generations to build. So let's get into how it all went so wrong. I mean, think about that for a second. How does a family fortune, something built over generations, how does it just vanish? In one generation? It sounds like something out of a book, right? But for one very real, very prominent American family, this was their reality. It really makes you wonder, what on earth could have happened to make it all fall apart so quickly? Well, the guy at the center of it all was this man, George Titan III. Now, he didn't actually build the family fortune himself, but as the patriarch, it was his job to protect it, to be the steward of it. And, as we're about to see, he ended up being the architect of its complete destruction. Okay, so to really get why this happened, you have to understand the world George grew up in, the world that shaped his entire mindset. For decades, investing just felt easy, almost like you couldn't lose. He was, as one person put it so perfectly, confusing brilliance with a bull market. And that's a dangerous mistake. And just look at this timeline. The momentum is just staggering. After World War II, the U.S. stock market basically went on this unbelievable, near uninterrupted tear for almost 30 years. For an investor like George, this wasn't just some trend. It was the only reality he'd ever known. Of course, unrelenting growth felt normal. Why wouldn't it? And you know, this wasn't just George thinking this way. Oh no. This optimism was literally everywhere. At the absolute peak of the market, in early 1973, you had Time magazine calling it a gilt-edged year. I mean, the consensus was totally clear. The good times were just going to keep on rolling. But of course, they were about to hit a brick wall. And then, it happened. Everything started to fall apart. Suddenly, the entire economic climate just shifted dramatically. That golden age was over, and a massive crisis was just getting started. Negative 45%. That's the number. That's what changed everything. In less than 2 years, between January 73 and December 74, the Dow Jones just collapsed. It lost nearly half its value. We're talking about one of the most brutal bear markets in American history, and it completely, utterly stunned investors like George. And look, the problem was so much bigger than just Wall Street. The entire U.S. economy was sick. Think about this. The economy was actually shrinking, but at the same time, prices for everything were soaring with double-digit inflation. It's this toxic, awful mix called stagflation, and it just created this feeling of constant crisis, and for families like the Titans, immense financial pressure. So here's where it gets really bad. While their investments were tanking, their spending habits, they didn't change one bit. It stayed fixed. So that meant the percentage of their fortune they were burning through each year just exploded, going from a high but kind of manageable 5% all the way up to a totally catastrophic 8%. They were basically forced to sell their assets at rock-bottom prices just to live, which just made the whole downward spiral go faster and faster. The pressure just became unbearable. So George, he retreats to this super exclusive club, locks himself in a room for 3 whole days and just thinks. And he comes to a decision. He then calls this secret family meeting. Get this, it was held behind a hidden door in a library to announce the decision that would, well, change their lives forever. So at this meeting, George lays out what feels like a completely airtight case for selling everything, every single stock. He tells them to just look at the world around them, the humiliating retreat from Vietnam, the oil crisis with insane gas lines, Watergate blowing up the presidency. He argued that American industry was getting crushed by competitors in Japan and Germany. You have to admit, hearing it all laid out like that, his logic felt pretty undeniable. And this right here, this was the heart of his entire argument. He basically said, I'm not selling out because of the bear market. I'm selling out because the American century is over. We've had our day in the sun. You see? He was insisting this wasn't some emotional panic sell. He believed he was making a cold, rational decision based on a new reality, that America's best days were over. He'd completely lost faith. And his speech was so powerful, so convincing, that when he was done, the family didn't just nod along. They gave him a standing ovation. Think about that. They were completely and totally united in making what would turn out to be the single worst financial decision of their entire lives. Just wow. Okay, so what happened next? They listened to him, they gave the standing ovation. Now let's get into the shocking aftermath and the truly devastating consequences of that one decision made in the summer of '74. This is the brutal, tragic punchline of the whole story. George Titan III, in his mission to save the family from any more pain, finished selling every last one of their stocks in August 1974. He sold at the absolute, literal rock bottom of the market. I mean, his timing could not possibly have been worse. And this timeline just lays out the true cost of that pessimism. It's painful to look at. They finished selling in August. By December, the bear market is officially over. Then, in '75 and '76, the market just snaps back, recovering everything it lost. And then, from 1982 to 1999, one of the greatest bull markets in history kicks off. And they missed all of it. They were on the sidelines for the whole thing. I mean, this just lays out the two different paths perfectly. On one side, you have the family's fate. They have locked in their losses forever and had to pay a massive tax bill for the privilege. On the other side, you have the market's fate. It roared back to life, hit historic new highs, and created unbelievable amounts of new wealth. The market they abandoned went on to fuel decades of growth, while the Titans themselves just slowly faded from a wealthy dynasty into a regular middle-class family. So you have to ask yourself, how could a decision that seemed so logical, so well-reasoned at the time, lead to such an absolute disaster? Well, let's break down the 4 big mistakes that really caused this whole thing to happen. Okay, so there are basically 4 catastrophic mistakes here. Number 1, George just failed to learn and grow. He never educated himself on investing. 2, he was working with completely the wrong kind of advisor. 3, he was just being sold stuff instead of actively buying smart advice. And finally, the nail in the coffin, abandoning stocks forever. Yeah, that wrong advisor thing is absolutely critical to understand. See, George's advisor at the bank operated under what's called a suitability standard. Now, that sounds okay, but it's a much lower legal bar than a fiduciary duty. A fiduciary has to act in your best interest. Suitable just means, well, it's not unsuitable. So they could sell him products that were maybe really expensive or didn't perform well, and as long as it was technically suitable for a rich guy, it was legal, even if it wasn't what was best for him. Look, this story about George Titan isn't just some dusty old history lesson. It is packed with powerful lessons for every single one of us. So let's connect his tragedy directly to you and what it means for any investor right now. So this is the real question, isn't it? How can you avoid becoming a George Titan? How do you make sure that fear or some bad advice or just losing perspective for a moment doesn't lead you down a path to making your own version of this catastrophic mistake? All right, here's your takeaway toolkit, the stuff you can actually use. First, and this is the big one, never, ever make huge financial decisions based on fear or emotion. Second, you have to understand the difference between a bad market, which happens, and a bad thesis, which means your idea is broken. Third, you've got to be an active, educated buyer of financial advice, not just someone who gets passively sold stuff. And finally, you have to recognize that real long-term growth requires owning growth assets, and that means stocks. And that really brings us to the final lingering question. Remember, George Titan confused a decades-long bull market with his own genius. So the question I want to leave you with is this. Is your portfolio built on real skill and a solid strategy, or just a bull market? Have you really thought about what you'll do when the tide inevitably goes out? Because as George Titan's story proves, confusing a lucky streak with brilliance, well, it can cost you absolutely everything. All right, today we're going to unpack the story of one family's massive financial crisis to find a lesson that is, frankly, critical for anyone with a financial advisor. It's a story about some pretty devastating mistakes, but it's also about a single question that can reveal everything about who you should trust with your money. So, let's just kick things off with the most important question you can possibly ask. It's really the heart of this entire story. Take a second and really think about it. Is your advisor working for you, or are they working for their company? By the end of this explainer, you're going to know exactly how to figure that out for sure. To really get what happened to this family in 2008, we actually have to rewind the clock a bit, back a whole generation. It all starts with a powerful lesson learned back in the 1970s, a lesson that was learned the hard way and then tragically forgotten. Okay, check this out. It's the 1974 bear market, and it is an absolute bloodbath. Two cousins, George and Jake, are watching their portfolios get hammered, but they make two totally different choices. George just hits the panic button, sells everything, and locks in a massive loss. His cousin Jake, on the other hand, he grits his teeth and just decides to hold on. And wow, did that one decision to be patient pay off. By staying in the market, Jake rode the incredible bull market that came next. For his kids, Ned and Rose, this story became legendary. It was their family's golden rule. When a crisis hits, you stay calm and you stay patient. All right, let's fast forward to 2005. Ned and Rose are in charge of the family money now, but they have new advisors. And their first meeting is with this guy, Frank Patterson, who is, well, let's just say he's a pretty aggressive salesman, and they were ready for him. So Frank comes in, guns blazing, pushing all these hot new funds with amazing 3-year returns. But Ned just cuts right through the sales pitch with this one simple question. He didn't care about the good times. He wanted to know how these guys handled a real disaster. And Frank, he was totally stumped. The test was on. So for the next meeting, Frank comes back thinking he's prepared. He's got a manager who's survived the crash. But Ned isn't done. He digs deeper and asks the one question almost nobody asks. He wants to know about the hidden fees. For the first time in Frank's whole career, a client was asking where the money was really going. And this is where it all comes together. Rose jumps in with the knockout punch. She exposes the huge conflict of interest right there in the open. You see, she's asking, are we seeing the best investments for us, or are we just seeing the investments that pay you the biggest commission? And that's the big aha moment, isn't it? They realized, wait a minute, this isn't a partnership. This is just a sales pitch. Frank wasn't an advisor on their team. He was a salesman playing for his own team. His interests were not their interests. Now let's jump to 2007. The fuse has been lit. All that distrust, all those unresolved problems, they're about to crash head-on into one of the biggest financial meltdowns in history. They have a new advisor, but the underlying issues are about to create an absolute perfect storm. So the markets are starting to feel pretty shaky, right? The Titans get nervous, and they go to their new advisor, Reggie Claus. They tell him, look, let's just move a big chunk of money, $25 million, into something completely, totally safe to ride this out. And that's exactly what the advisor told them he was doing. He used all the right words, safe, money market-like. And it was with Lehman Brothers. I mean, back then, that name felt like a rock-solid guarantee. So they signed the papers. But here's the catch. It wasn't a money market account. Not even close. It was this way more complicated thing called an auction rate security. And buried deep in the fine print was a ticking time bomb. Their ability to get their own money back depended entirely on a little weekly auction going off without a hitch. And well, you can probably guess what happened next. The financial world starts to crumble, and that remote possibility becomes a brutal reality. The auctions just stop working. And like that, poof, their safe $25 million was frozen solid, completely untouchable. And as if that nightmare wasn't bad enough, at the exact same time, the rest of their portfolio was just getting hammered. The market was in a complete nosedive. I mean, can you imagine? Your safe cash is frozen, your stocks are collapsing, you're trapped. So in total desperation, they call their trusted advisor, the guy who's supposed to guide them through the storm. But he panics, and he tells them to do the one thing their family history screamed not to do: sell it all, right at the absolute bottom of the market. Unbelievable. So they fired their advisor, they've hit rock bottom, and then a bit of fate steps in. Rose is at this charity dinner, and a random conversation she has at her table is about to change, well, pretty much everything. She ends up telling her whole horror story to the guy sitting next to her, Ralph, and he listens, and then he says something that just flips a switch in her brain. He says, look, your problem wasn't just one bad advisor. The whole system you were in is designed this way. And then he tells her about a completely different kind of advisor, a kind she had never even heard of. They're called investment consultants. And get this, they don't sell any products. They don't work for a big bank. They work directly for you. That's it. They have a legal duty to act in your best interest. They're a true fiduciary. And this right here, this is the whole ballgame. A typical broker, their loyalty is usually to the firm that signs their paychecks. Their motivation is making a sale, getting a commission. But a consultant, they are legally bound to put you first. Their only motivation is your success. It's all about whose side of the table they're sitting on. So, what the Titans went through, as awful as it was, actually gives all of us a clear roadmap, a playbook for what we should demand from anyone giving us financial advice. It's all about finding someone with what we can call a fiduciary mindset. So what does that look like? Okay, number 1, demand full disclosure. You have a right to know every single fee and every single conflict of interest, period. Number 2, look for patience. A real pro doesn't rush you into a sale. They take the time to build trust. Number 3, expect a consultant's mindset. Their focus should be on your big picture strategy, not just the hot product of the week. And finally, and this one is huge, test them in a crisis. Any advisor looks smart in a rising market. Their true value shows up when things get ugly. And that brings us right back to where we started, with that one big question. But now you see it a little differently, don't you? After hearing what the Titans went through, you know what the stakes really are. So I'll ask you one more time. Is your advisor really, truly playing for your team? The answer to that question could make all the difference in the world.
Welcome to The Explainer. Today, we're going to break down a smarter way to hire a financial advisor by following the playbook of one very wealthy and very clever family, the Titans. You'll see their whole process values human connection way more than paperwork, and honestly, it's a lesson for all of us.
So let's start with the big question. It's the one Ned and Rose Titan faced when they started looking for a new financial advisor. I mean, think about it. You're responsible for your family's capital. That's a huge weight. This choice isn't just about money, right? It's about trust, it's about vision, and it's about securing a legacy for generations to come.
Now here's the interesting part. The Titans didn't have some standard process to follow, and that inexperience, it actually became their biggest advantage. Because they didn't know the proper way to do things, they just invented their own, and it turned out to be more intuitive, way more human, and, in the end, a lot more effective. Okay, let's dive into the Titans' very first step, which is so counterintuitive it completely flips the traditional search process on its head. It's a really simple idea, but it has some pretty powerful implications. Just look at the contrast here. The standard way to do this starts with a massive impersonal document, the RFP. But the Titans, they started with a handshake. They actually went and visited firms first, just to feel the culture, to see how people interacted with each other, and to trust their gut. Then, and only then, did they send out a really focused RFP to just a select few. And their whole approach worked because they understood a simple truth. A firm's culture tells you way more than any form ever could. You know, human judgment, it needs to see people in their element, not just a bunch of numbers on a spreadsheet.
All right, let's move on to the request for proposal, or the RFP. We're going to see how the Titans avoided this really common trap that just buries families in useless data, turning a search for a partner into a tedious game of paperwork.
Can you imagine sending a document with over 100 questions to, say, 10 different firms? You'd get back literally thousands of pages of responses. This whole approach, it values the appearance of being thorough over actually finding the right fit. It's a game advisors are great at playing, but it doesn't really help the family.
So instead of 100 generic questions, the Titans just asked a handful of really smart, open-ended ones. See, these weren't about data, they were about character. Asking about conflicts of interest, or, my personal favorite, why other families don't hire them. That gets right to the heart of a firm's integrity.
And for them, a thoughtful, transparent response was so much more valuable than some perfectly rehearsed, canned answer. If a firm seemed kind of baffled by a question or was super rigid in its answers, well, that told the Titans everything they needed to know about their culture and their flexibility.
Okay, now we come to what is arguably the most critical part of this entire process: negotiating fees. Here, the Titans avoided a catastrophic mistake, which we can really see through the cautionary tale of another family.
So let's meet the Cheap family. They drove a really hard bargain on their advisor's fee for their $100 million portfolio. And they won the negotiation. They got a discount and they were celebrating what they thought was a fantastic deal.
They were absolutely laser-focused on this one number, 7 basis points. Now, a basis point is just 1/100%, so this was a 0.07% discount. On their portfolio, that meant saving $70,000 a year. On paper, that looks like a clear win, right?
But, and this is a huge but, here's what was happening behind the scenes. The advisory firm knew the Cheat family's account was now officially below its minimum profit margin. So what did? They underworked it. The senior advisor spent almost no time on their account, and they just left it to junior staff to manage.
And this is where the real cost started to show up. The junior staff, well, they overlooked an underperforming manager for months. They made sales that triggered high short-term capital gains taxes, when just waiting a little bit longer would have saved a fortune. They were even placed in higher-priced retail investment products instead of the institutional versions they actually qualified for. All these small, invisible mistakes, they really started to add up.
So here's the bottom line. Their 7 basis point savings were totally wiped out by hidden losses of 22 basis points per year, all due to simple neglect. By focusing only on the sticker price, they ended up paying way more in the long run.
All right, so after navigating that whole process with some serious wisdom, the Titans made their final selection simple, focused, and incredibly effective.
You see, because of all that initial legwork, the in-person visits, the smart questions, the focus on culture, the Titans had already done all the hard work. By the time they got to the end, the field was narrowed down to just 2 excellent firms. They literally couldn't make a bad choice.
And this final interview agenda is just brilliant. It's short, it's sweet, and it's effective. The family leads, the advisor gets just 15 minutes to make their case, and the whole thing is over in 90 minutes. This kept everyone focused and really showed that the Titans were the ones in control.
Since both firms were technically qualified and really were excellent choices, the final decision could be based on what truly matters in a long-term relationship. It all came down to the human element. Who did they feel more comfortable with? Who communicated better? Who felt like a true partner?
And that really leaves us with one final thought. The big takeaway from the Titans' journey is to ask yourself this question: is your advisor a true partner, or are they just a vendor? Because as we've just seen, the price you pay for advice and the value you actually receive, well, they can be worlds apart.
You know, have you ever wondered what the real difference is between someone who just sells you financial products and a true advisor? Well, we're about to find out. We're going to listen in on a single meeting that completely changed one family's entire financial future. It really pulls back the curtain on the huge gap between a simple vendor and a real partner.
So, our story kicks off with a feeling that I'm sure a lot of us can relate to: fear. Rose Titan says it all right here. The thing is, Carrie, we got very nervous, and we began selling stocks. I mean, that just captures the panic that so many people felt during the last big crisis, and it led her and her husband to make some pretty major decisions. So we're going to follow this couple, Ned and Rose Titan, as they sit down for the very first time with their new advisor, a woman named Carrie Knowlton. Now they walk in thinking they're just going to go over their portfolio, you know, the usual stuff. But what's about to happen is a series of realizations that will completely change how they think about their money forever.
Okay, so right out of the gate, Carrie, the new advisor, she doesn't mess around. She goes straight to the heart of the issue.
And she tells them that their biggest problem isn't what they think it is. The real issue, she says, is that their portfolio is just way, way too cautious.
And a quick look at the numbers here really tells the story. You can see their portfolio was only 37% in stocks, all because they sold off when they got scared. Carrie's recommendation? Almost double that. And here's the crucial part. At 37%, there is just no way their money is going to keep up with inflation, with taxes, with fees over the long haul. Their caution has actually become its own kind of risk.
So you can imagine Ned and Rose are pretty nervous about jumping back into the market. And as they're trying to explain why, this ghost from the family's past shows up. They're totally haunted by the story of their Uncle George.
And this is where Carrie asks what turns out to be the single most important question of the whole meeting. So, they explain that Uncle George sold all of his stocks at the rock bottom of that brutal 1974 bear market. And Carrie just asks the simple, logical follow-up, so when did he get back in?
And there it is. One word. One devastating word that just changes the entire tone of the meeting. He didn't. He never got back in. He let a temporary market panic turn into a permanent, life-altering financial mistake.
And this just lays it all bare, right? It wasn't the market crash that destroyed Uncle George's wealth. Nope. It was staying out of the market afterwards. Because he was trying to avoid any and all risk, he missed the monster bull market of the 80s and 90s. And his family's fortune, it just evaporated. The story proves that sometimes the biggest risk you can take is not being invested at all.
So now that the why is crystal clear, Carrie immediately gives them a how. And notice, she doesn't just say go buy stocks. No way. She gives them a clear, gradual, and, psychologically manageable plan. No big, scary moves. Just a disciplined, step-by-step process to get them back where they need to be over 9 months. It turns a terrifying idea into a totally achievable strategy.
Okay, so they've got a plan for the investments. But a truly great advisor knows that's only part of the puzzle. See, long-term success isn't just about what you own. It's about how you make decisions. So Carrie shifts the focus to building a solid framework for the family's future.
And she starts by asking a really simple but profound question about something called governance, which is just a fancy word for having a formal process for making those big money decisions. She suggests they bring back their family investment committee.
So, what's the big deal with having a committee? Well, it's not about having more cooks in the kitchen. It's about bringing structure and discipline to the whole process. A committee gives you some unbiased outside judgment. It's a support system when you have to make those really tough calls, like, buying when everyone else is panicking. And, critically, it can act as a tiebreaker so that a simple disagreement between two people doesn't freeze everything up.
So they've shored up the present. What about the future? Carrie pivots the conversation to their adult kids. Eventually someone else is going to have to take the reins. So the question becomes, how do you actually prepare the next generation to be smart about the family's capital?
And her suggestion here is just genius. Seriously, instead of some boring lecture, she proposes an assignment. She suggests that the kids should be the ones to write the first draft of the family's investment policy statement, which is basically the constitution for their entire portfolio. This is brilliant. It turns education from something passive into an active, engaging, and really meaningful project.
All right, so now we get into the nitty-gritty, the actual investment managers, the people picking the stocks and bonds, and the reports they use to track everything. But even here, Carrie does something different. She shifts the focus away from who and on to how.
And this is a bit of a bombshell. Carrie reveals that the managers in their portfolio weren't picked because they were the best of the best. Oh no. They were there because they paid the Titan's old advisor to get on his recommended list. The whole portfolio was built to make the broker money, not the client. That is the classic vendor model, right there.
And this slide just lays out the difference so clearly. The old way, the typical way, is all about spreading the responsibility around so that if a manager does poorly, hey, no one person gets the blame. It's totally defensive. Carrie's way is the complete opposite. She does the research, she does the vetting, and she brings one recommendation to the table and basically says, this is on me. It's a process built for accountability, not for avoiding blame.
Okay, let's talk about reports. We've all seen them, right? Pages and pages of numbers and charts that just make your eyes glaze over. Well, a good advisor's report, like the one outlined here, is designed for one thing, for you, the client, to actually understand it. It starts with a summary in plain English. It compares the results to the right benchmarks, and it ends with clear, actionable recommendations. The goal is clarity, not to impress you with complexity.
So the meeting wraps up. Ned and Rose are walking out, probably with their heads spinning a little bit, thinking about everything they just discussed, and then it hits them. It clicks. They finally realize why this meeting felt so completely fundamentally different from any they'd ever had before.
And Ned is the one who puts his finger on it first. He says, it wasn't like meeting with a vendor. It was like she was part of our team. Think about that. This wasn't a transaction. It wasn't someone trying to sell them something to make a commission. It felt like a partnership. It felt like Carrie had actually joined their team.
And then Rose just paints the perfect picture with her words, like she was sitting on the same side of the table with us. And that's it, isn't it? That is the absolute core of what a true advisory relationship should feel like. It's someone sitting right there next to you, looking out at the complicated world of finance with you.
So what can we all take away from Ned and Rose's experience? What are the real practical signs that tell you you're working with a true partner and not just another vendor?
Think of this as your checklist. A true partner focuses on the big picture strategy first. They're willing to talk about the uncomfortable truths. They bring up things like governance and educating your family, not just which products to buy. They take responsibility, they prioritize your understanding over complexity, and they make you feel like they are on your team.
And that really brings us to the final and maybe the most important question. It's a question you should ask yourself after every single meeting you have about your money. Just look across the table or, the Zoom screen and ask yourself, is this person on the other side trying to sell me something, or are they a partner sitting right here next to me? The answer to that question, well, it tells you everything you need to know.
You know that old story, right? A family builds a huge fortune from nothing, and then poof, within a couple of generations, it's all gone. It's a huge puzzle, and it happens all the time. So today, we're going to dive into exactly why that happens, and more importantly, we're going to unpack a powerful game plan that can help any family make their legacy last.
So, let's start with a saying that's been around for ages. It's this phrase that perfectly describes a problem so common it almost feels like some kind of unavoidable curse. You've probably heard the American version, right here. But what's really fascinating is that this isn't just an American thing. It's a human thing. Seriously. In China, they have a saying, rice paddies to rice paddies. The story is exactly the same no matter where you go. The first generation builds it, the second generation enjoys it, and the third generation, well, they lose it.
And it's not just some old wives' tale. The numbers are absolutely staggering. A full 90% of wealthy families have lost their entire fortune by the time the grandkids are in charge. Now, this isn't just a string of bad luck. It's a predictable pattern, and it's rooted in how we think, a little bit of math, and a massive failure to plan for the long, long haul.
Okay, so to really understand how to break this cycle, let's look at a story. We're going to call them the Titan family. They're this multi-generational wealthy family, and the younger generation is just now starting to realize the enormous weight of responsibility that's headed straight for them. So the family's advisors send over this really important document, an investment policy statement. And this right here, this was the reaction from Billy, one of the younger Titans. And he wasn't the only one. The next generation was totally lost. And I think we can all relate to that feeling, right? Staring at some complex financial document and just feeling overwhelmed. Their journey from that confusion to real clarity is going to be our roadmap.
You know, the first lesson the young Titans had to learn wasn't about finding the next big stock or chasing some crazy return. No, it was a complete shift in their mindset. Their advisors basically told them, look, when you already have wealth, the game totally changes. Your number one goal isn't growth anymore. It's protecting what you have. It's all about playing defense.
So to really drive this point home, the advisors explained that keeping wealth is all about understanding three powerful, kind of counterintuitive ideas they called asymmetries. Think of these as the three big reasons why avoiding losses is way, way more important than chasing big gains for a family that wants their money to last for generations.
First up is what they called behavioral asymmetry. All the research shows that as humans, we hate losing money way more than we love making it. And that fear, it makes people panic. The Titans had this perfect and frankly painful example in their own family history. Uncle George. He got spooked during a big market downturn, sold everything at the absolute bottom, and his branch of the family, well, they never really recovered.
Okay, this next one is just pure math, and it's a real eye-opener. The advisors posed this really simple question to the Titan kids. Let's say you start with $1 million. All right, in year one, you have an amazing year. You're up 50%. Fantastic. Then in year two, it's a disaster. You lose 50%. So where do you end up?
Most people, just like the Titan kids, think, oh, well, you're right back where you started, at $1 million. But you're not. Not even close. You're down $250,000. And why is that? Because a 50% loss requires a 100% gain just to get back to even. That's the mathematical asymmetry. The big takeaway is this: losses just hurt you so much more than gains help you.
The last piece of this puzzle is what they called lifestyle asymmetry. And Rose Titan, she got this one instantly. Think about it. For a family that's already wealthy, getting even richer is, well, it's nice, but it doesn't fundamentally change their life. But getting poor? That is an absolute catastrophe. The downside risk is just infinitely bigger than the potential upside.
So once you understand these three asymmetries, it forces you to make this really profound philosophical shift. It makes you change how you even look at the money itself. You have to ask a really basic question. Are you an owner of this wealth, or are you a steward?
And this quote just nails it. During their family meeting, someone brought up this famous advertising slogan. It's the perfect metaphor. The wealth isn't really yours to do whatever you want with. You're just its current caretaker. You're in charge of looking after it for the next generation.
This chart lays it all out side by side. An owner thinks, hey, this money is mine. I can spend it. But a steward thinks, this capital is a family legacy. The owner is focused on their own generation, their own needs. The steward, they're thinking about future generations, and maybe even the community. Making this one single shift from owner to steward, that's the absolute bedrock of building a financial dynasty.
Okay, so this all sounds great in theory, right? Stewardship, long-term thinking. But how do you actually do it? How do you turn this big idea into an actual plan? Well, you need a tool. You need a document that captures this entire way of thinking and guides every single decision the family makes.
Remember that document that totally confused Billy Titan at the beginning? Well, it turns out it's the key to the whole shebang. It's called an investment policy statement, or IPS. But honestly, a much better way to think about it is as your family's financial constitution. It's the rulebook you write together during calm times so you can follow it during the chaotic times and avoid panic. And here's the thing, a great IPS isn't just a bunch of numbers and charts. It's about a family's soul. The whole process forces everyone to sit down and answer 4 really profound questions together. Who are we? What do our values say about this money? What is its ultimate purpose? How are we going to protect it? And maybe most importantly, how will we hold ourselves accountable to this plan? And that's the ultimate power here. This process, it takes a whole group of different people, with their own opinions and emotions and fears, and it aligns them. It turns them into a single, focused team. The IPS is the practical, real-world tool that lets a family actually beat that 3-generation curse.
So we'll leave you with this one last thought to chew on. And it doesn't matter if you're managing a huge fortune or just starting to build one. This question gets right to the heart of it all. If your family's money had a voice of its own, what would it ask of you? Really thinking about that and trying to answer it like a steward is the very first step to creating a legacy that can actually last.
You know, it's funny. Most families that get rich, they don't stay rich. You've probably heard the old saying, shirt sleeves to shirt sleeves in 3 generations. So what happens when a family has already beaten those incredible odds? How do they even begin to plan to keep their wealth, not just for their kids, but for centuries to come? Right, let's just dive right into that. Because this question, it's not really just about spreadsheets and stock picking. It's about family, it's about history, and honestly, it's about the very human challenges that come along with having a massive fortune. We're about to get a really rare, fly-on-the-wall look at a high-stakes family meeting to see how one family tries to solve this exact problem. So let's meet the family at the heart of this, the Titans. They're already in their 5th generation of wealth. They call it G5, which is, believe me, incredibly rare. We're basically sitting in on their meeting with their financial advisors. You've got the patriarch Ned and matriarch Rose, and then the younger generation Ellen and Jeffrey. And trust me, this is no ordinary meeting. Okay, so the first part of the agenda seems simple enough, right? The advisors kick things off by asking Ned and Rose about their personal financial goals. Pretty standard stuff. What do you want your money to do for you in your own lifetime? And their goals are pretty much what you'd expect. They want to support their lifestyle, make sure their money keeps up with inflation for the next 20 years or so, give a good chunk to charity, and then, pass on whatever's left. It's all very sensible, very clear, and very focused on their lifetime. But this straightforward plan, Yeah, it's about to get real complicated. This is where the mood in the room really shifts. The tension starts to build when the conversation turns to something called the Grandchildren's Trust. Now, this isn't some 20-year plan. No, this is a financial tool with a time horizon that is just almost impossible to wrap your head around.
That is not a typo. The year 2100. This trust was set up by Ned's grandfather just before World War II. And because of this old legal rule that limits how long a trust can last, it's not scheduled to actually pay out its money until around the year 2100. And for the younger generation, for Ellen and Jeffrey, this isn't just some boring financial detail. Oh no, this is a huge source of frustration. And this slide just lays out the whole fight perfectly. On one side, you've got Ned and Rose. They see the trust as this brilliant financial tool. It saves a ton on taxes, it protects the assets, and it basically acts as this long-term security blanket for the family. But Ellen and Jeffrey, they see it completely differently. To them, the money is just tied up. It's being controlled by the dead hand of the past. They feel like they have no control, no influence, and frankly, they feel like it's treating them like children.
Jeffrey just captures the whole feeling of the younger generation with this one line. His great-grandpa inherited the money with no strings attached, but now, generations later, his own inheritance is locked away in this complex legal box. It feels totally unfair, and it really begs the question, why do these things even exist in the first place?
So Carrie, the family's advisor, she sees this fight brewing, and she does something really smart. She hits pause on the whole debate. She says, look, to understand this conflict, you have to understand the surprising history of the trust itself, which, believe it or not, goes back almost 1,000 years. What's so wild here is that the idea of a trust isn't some newfangled tax loophole. It actually came out of these English courts of equity way back in the 12th century. It was a way to make sure things were fair when the written law was just too rigid. It separates who legally owns something from who gets to benefit from it. But get this, not everyone thought it was a great idea. After the French Revolution, they actually banned trusts. They were afraid they'd create this lazy, unproductive class of heirs. And that fear, that idea of creating a failed class, that is exactly what's on the younger Titans' minds. They're worried about what some people have called the disease of affluenza, this risk that just being handed a ton of money can actually do way more harm than good. As their advisor points out, this condition often strikes right around the third or fourth generation. That's the point when the memory of someone actually having to work for a living has kind of faded from the family. Ellen even says she saw it herself in college. Kids who were just coasting, totally dependent on their trust checks, with zero drive or purpose in their lives. And then Joffrey makes this really provocative comparison. He says, look, if someone is getting $100,000 a year from a trust, what's their motivation to go out and take a tough, stressful job that only pays, say, $35,000? He then asks, is that really any different from someone on welfare who might be able to make almost as much by not working? Now, the point here isn't to judge anybody, but to shine a light on this universal truth about incentives and what drives human nature. Okay, so after that really deep, almost philosophical debate, the advisors have to steer the conversation back to earth, back to the practical stuff. It's time to translate all these family values and fears and goals into a real, concrete investment strategy. In other words, it's time to start speaking investmentese. And this table just lays it out so clearly. You can see how the totally different purposes of these two pots of money lead to completely different strategies. For Ned's personal money, you're talking a 20-year horizon. They need it to be accessible, so the risk has to be lower. But the Grandchildren's Trust, with a 100-plus-year timeline, it can take on way more risk to shoot for a slightly higher return. Now, the family's goals are all framed in terms of what's called absolute return. They're not trying to beat the S&P 500 every single year. That's a different game. The really crucial thing for them is hitting a specific, real-world target. They want to grow their wealth by, say, 3% more than whatever inflation is, after you account for all their expenses and spending. It's about meeting a goal, not winning a race against a benchmark. So as the family is really starting to grapple with just how hard it is to maintain wealth, let alone grow it, their advisor, Carrie, shares this chilling story. It's a real-world case study of just how frighteningly fast a massive fortune can completely disappear. So he tells them about a former client, a family that was worth nearly $1 billion. I mean, $1 billion. They had everything you could possibly imagine. But they made a series of absolutely catastrophic mistakes that serve as this incredibly powerful warning. So here's how it all went down. First, the family had pretty much all their money in one single stock. Then, as that stock just skyrocketed, they started spending like crazy. We're talking jets, mansions, the whole thing. To pay for it all, they borrowed millions and millions against their stock. Then, disaster. The stock crashed. The lender made what's called a margin call and just seized and sold all their shares at rock-bottom prices. The result? The fortune was gone. But worse than that, the family was completely destroyed by lawsuits and bitterness.
And this right here is the key lesson from that whole tragedy. When all your wealth is tied up in one single thing, you're not an investor anymore. You're a gambler. The market simply doesn't reward you for taking on that kind of concentrated risk. And if you think for a second that any single company is totally safe, just look at this list. This is a graveyard of giants. These were all dominant, seemingly invincible companies that eventually just collapsed or became shadows of what they once were. No single stock, I don't care how great it seems today, is a guaranteed bet forever.
Which really brings us to the fundamental principle that guides the Titan's entire strategy. Very, very few people get rich from the stock market alone. You get rich by building a successful business, just like the first Titans did. The market, well, the market is the tool you use to stay rich, to preserve all that hard-earned capital for generations. As this meeting with the Titans shows, preserving wealth over the long, long haul isn't just about spreadsheets and stock picks. It's about navigating messy family dynamics, these huge historical forces, and just basic human nature. The line between success and failure is a razor's edge, which kind of leaves us with a question for all of us, doesn't it? What's the plan that's protecting your legacy?
Asset allocation. It's one of those phrases you hear all the time. Every financial expert tells you it's the most important thing for long-term investors to get right. But what if I told you the conventional wisdom is maybe a little bit wrong? In this explainer, we're going to dig into why the most common advice you hear might not be the whole story.
Okay, so right out of the gate, we're throwing you a curveball. We've all had it drilled into our heads that asset allocation is everything. But this quote here suggests that's not always the case. So let's unpack that. Why on earth can this common wisdom be so misleading?
So, here's our game plan. First, we're going to bust that big myth wide open. Then, we'll get into the real power behind diversification. We'll translate some of that confusing jargon around risk and return, then see how the pros actually build portfolios. After that, we'll look at why our own brains sometimes trip us up, and we'll wrap it all up with a disciplined investment process you can actually think about.
All right, let's dive right in with that myth. Why exactly is this idea that asset allocation is the be-all and end-all potentially a trap?
This slide breaks it down perfectly. I mean, look, in a really extreme case, like if you're comparing a portfolio that's 100% stocks to one that's 100% bonds, then yeah, of course, asset allocation is the only thing that matters. The difference is night and day. But let's be real, that's not how most people invest. In a more realistic scenario, where you're just tweaking things by 5% here or there, well, suddenly other things, like who's managing your money or which specific stocks you pick, can actually have a bigger impact on your results.
So, here's the real secret sauce. The true power of asset allocation isn't about sweating over a few percentage points. It's about setting up a smart, disciplined, long-term game plan that actually fits your life and your goals. And this is the most important part, having the guts to stick with that plan, especially when the market gets scary.
And that leads us right to the bedrock of any good strategy, diversification. Now, I know, we've all heard the old cliche about eggs and baskets, but its true power is something people really underestimate.
I mean, just think about it. This idea is ancient. We're talking thousands of years old. Ancient traders didn't have fancy spreadsheets or complex algorithms. They just had common sense. They knew that if you put all your valuable cargo on one ship and that ship goes down, you're ruined. But if you split it between two ships, you've dramatically increased your chances of success. It's the exact same logic we use today.
And this is where the real magic happens. When you mix together different kinds of assets that don't all go up or down at the same time. What the pros call not highly correlated, something amazing occurs. The ups of one thing can cancel out the downs of another. This smooths out the ride, which lowers your overall risk. And here's the kicker. You often lower your risk by more than you lower your potential return.
They call it the closest thing to a free lunch in investing. And honestly, they're not wrong.
Okay, but to really get this, we've got to get comfortable with the lingo. So let's take a minute to bust some of that jargon that makes finance feel, well, super intimidating and designed to go over our heads.
Yeah, this is a fantastic question. Your advisor says something like, this portfolio has a risk level of 16%, and you just kind of nod along, right? But what on earth does that actually mean for your money? Let's break it down.
Okay, so that 16% risk is just a fancy word for volatility. It's basically a measure of how bumpy the ride is expected to be. So if stocks on average give you an 8% return, that 16% volatility means that roughly 2/3 of the time, your annual return should land somewhere between a 24% gain on the high end and an 8% loss on the low end. It gives you a ballpark for the kind of swings you should be prepared for.
All right, now this leads to a concept that is so important, but almost nobody talks about it. It's called variance drain. You can think of it like a hidden tax that volatility charges you. The wilder the swings your portfolio takes, the more your growth gets eaten away over time. It's the reason why two portfolios with the exact same average return can end up with totally different amounts of money in the end.
And I absolutely love this analogy. Picture two journeys, both with the same average of 8%. One journey is a smooth, gentle, wavy line. The other? It's a rugged, jagged mountain chain with huge peaks and deep valleys. Even though their average height is the same, you will end up with more money by taking the smoother path. Why? Because those huge drops, those deep valleys, require massive climbs just to get back to where you started. That's variance drain in action.
Okay, so we get the building blocks. Now how do we actually put them together to build the right portfolio? This is all about finding what the pros call the efficient frontier.
Well, financial advisors have a pretty powerful tool for this. It's called mean variance optimization. And basically, they feed a computer tons of data about different assets, their expected returns, their volatility, how they tend to move with or against each other. And then the computer just crunches thousands, sometimes millions of possible combinations to find the absolute best mixes.
And what comes out of all that number crunching is this beautiful curve you see here, the efficient frontier. Think of it as the gold standard. Every single dot on that line represents a portfolio that's perfectly optimized. It's giving you the most possible return for a specific level of risk. Now, if your portfolio, let's call it portfolio X, is floating around below that line, that's a problem. It means you're being inefficient. You're taking on more risk than you need to for the return you're getting.
Now here's the thing. We could build the most mathematically perfect, efficient portfolio on the planet, but we'd be forgetting one giant, unpredictable variable in the whole equation: us, our own brains. This is about the clash between logical models and our often illogical minds.
I mean, come on, who doesn't love this quote? We all know, logically, that the color of your socks has zero impact on a golf ball. But our brains are hardwired to find patterns and make connections even when they aren't really there. And in investing, that same little mental quirk can lead us to make some really bad, emotional decisions.
And look at this list. These are just a few of the mental shortcuts and traps our brains set for us. Things like herd behavior, buying something just because everyone else is, or being way too confident in our own genius. These biases are universal, and they can be incredibly destructive to a portfolio.
Let's just zoom in on one of these, the gambler's fallacy. We've all felt this, right? You're at a slot machine, it hasn't paid out in forever, so you start thinking, man, it's got to be due for a win. But nope. Every spin is a totally random, independent event. The machine doesn't care what happened before. And guess what? The market is a lot like that slot machine.
Okay, we've talked theory, we've busted jargon, we've looked in the mirror at our own psychology. Let's bring it all home. Let's talk about a real-world discipline framework that can lead to success.
This isn't just a checklist. It's a living, breathing process. And notice something really important here. Setting up your long-term plan, that core asset allocation, that's just step one. The real work, the thing that separates amateurs from pros, is the cycle that follows. It's a continuous loop of assessing, adjusting, and monitoring. It's a discipline, not a set-it-and-forget-it kind of deal.
And within that whole process, these two little rules of thumb about liquidity, honestly, they are priceless. The whole point here is to build a fortress around your finances so you are never forced to sell your investments when the market is crashing. Having enough cash and income to cover your life for a few years is what gives you the power to ride out the storms and stick to your plan.
So, we'll leave you with this question to chew on.
A truly great portfolio isn't just about maximizing returns on a spreadsheet. It's a tool designed to serve your life and your needs. The real question is that tool tough enough? Is it engineered to withstand not just the storms in the market, but also the emotional storms that can rage inside your own head? Answering that, well, that's the true test of a great asset allocation strategy.
Welcome to The Explainer. Today, we're going to pull back the curtain on a huge myth about how the super rich invest their money. We'll be using insights from Gregory Curtis's Family Capital to show you a strategy that pretty much flips conventional wisdom on its head.
Okay, so let's get right into it. When you think about how the ultra-wealthy really grow their fortunes, what's the first thing that pops into your head? Is it all about finding that next investment guru, or is there something else going on?
I'm willing to bet that for most of us, we picture some kind of superstar manager. You know, a financial wizard who just magically beats the market, year in and year out. But here's the twist, and it's a big one. According to our source material for the elite advisory firm we're looking at, choosing a manager is actually the final, and get this, the least critical step in their entire process.
So, if picking the manager isn't the priority, what is? Well, it all starts with two really fundamental strategic questions they ask first. The very first question is all about price. Before they even think for a second about who will manage the money, they figure out if entire market sectors are cheap, if they're fairly priced, or if they're just plain expensive.
And this whole strategy really hinges on a powerful concept called mean reversion. Now, it sounds a little technical, but at its core, it's a simple idea. Markets tend to act like a pendulum, always swinging back to their long-term average over time.
And this chart just illustrates that point perfectly. If a market has underperformed for a decade, they'll actually forecast higher returns for the next decade. And if it's been soaring, well, they're going to dial those expectations way back. See, they aren't trying to predict the future, they're just positioning their capital based on what's on sale and what's overpriced.
All right, the second part of their strategy is all about hunting for hidden gems. They're looking for these opportunistic investments that most standard portfolios would just overlook, but are simply too good of a deal to pass up.
Now, this case study is just a perfect example of how this process works in the real world. So picture this. Oil prices totally collapsed. Investors panicked and sold off everything even remotely related to the sector. But these advisors, they looked for assets that were being thrown out with the bathwater. Things like oil pipeline companies, whose profits are actually based on the volume of oil, not the price of it. They went in and bought these high-quality assets at a huge discount.
Okay, so if the advisory firm is making all the big strategic calls, what's even left for the manager to do? Their role is probably not what you think it is.
This quote from the source really says it all. The goal isn't to find a superstar, it's to find a steady hand who won't crash the ship. It is all about damage control.
And a huge piece of this damage control is avoiding what are called agency issues. This is basically when the manager's goals don't line up with the family's goals. For instance, a manager might be tempted to just grow their fund as big as possible to earn more fees, even if that actually hurts investment performance for the client.
So you can just forget the whole idea of a visionary genius. The manager's true role is to be a specialist, an expert, who can implement the strategy that's already been decided on without making any big, costly mistakes.
But just how hard is it to pick a winning manager, even when all you're looking for is a safe pair of hands? Well, the answer is pretty sobering.
To see just how tough this is, our source gives us a fascinating case study. A top-tier firm whose entire job is to pick the absolute best hedge funds decided to audit their own 20-year track record.
Over those 2 decades, they invested in 51 different elite hedge fund managers, and all of them were carefully vetted.
And the results were frankly shocking. Out of those 51 hand-picked managers, 26 of them performed as expected. But the other 25, they were fired. That's a success rate of barely 50%.
I mean, think about that for a second. Even for the absolute experts, with all their resources and all their access, picking a successful manager was basically a 50-50 bet. No better than a coin flip.
So what does this all mean for the rest of us? You know, the ones who don't have a multi-billion-dollar trust fund.
The key takeaway is this. You've got to shift your focus from the who to the what and the why of your investments. The strategic decisions you make before you ever choose a fund are what truly drive your success.
So the crucial point
is that your long-term success depends way more on your overall asset allocation, your assessment of market value, your discipline, and how you behave during a crisis. It's all about the game plan, not about trying to find a star player. And that really leaves us with a final question for your own approach. Are you out there searching for a star player, or are you focused on designing a winning game plan? Thanks for watching.
All right, let's jump right in. Today, we're going to pull back the curtain on something that trips up just about every investor: how to review your performance. We're going to see how the pros really do it, and let me give you a spoiler: it looks nothing like what you see on the news. First, just be honest with yourself for a second. How often do you find yourself pulling up your portfolio on your phone? A few times a week? Maybe? A few times a day? You know, it feels diligent, right? Like you're being responsible and staying on top of things. But what if I told you that very instinct might actually be costing you a lot of money? Okay, get ready for a bit of a reality check. The source material for this explainer makes a really bold claim right from the start. All that stress you feel over how your portfolio did in one quarter, all that anxiety, well, according to the experts, it means essentially nothing. It's just noise. So here's the crucial point. The real battle isn't against a volatile market or a bad economy. The battle is internal. The single biggest threat to building your long-term wealth is our own set of hardwired, short-term instincts that make us do exactly the wrong thing at the worst possible time. So how do we win this battle? Well, we start by taking apart the very myths that feed our worst instincts. We're going to tackle the most common and damaging beliefs about investing, and we'll start with our obsession with fresh, up-to-the-minute data. So this slide really shows a huge contrast. On the left, you've got what we instinctively want: instant information, quick decisions. But now look at what the pros do. They intentionally use stale data. They schedule meetings weeks after a quarter's even over. Now, this isn't laziness. It's a very deliberate strategy to force a long-term perspective and stop us from having a knee-jerk reaction to every little blip in the market. Okay, let's move on to our first big myth, and you'll see how this all connects. It seems so simple, right? A positive return is good. If your portfolio is up, you're winning. But professionals know that the final number, well, that's only a tiny, tiny part of the story. So let's say you hired a fund manager, and they're just knocking it out of the park, absolutely crushing their benchmark. That's fantastic news, isn't it? You clearly picked a genius. Or did you? This is where we run into a really critical idea called style drift. So imagine you hired a manager specifically to invest in small, undervalued companies. But to get those amazing returns, they secretly started buying big, popular tech stocks. They've drifted away from their style. It's like hiring a marathon runner who decides to compete in the 100-meter dash. They're just not doing the job you actually hired them to do. And this is exactly why a great return can sometimes be a huge red flag. A manager who's operating outside of their expertise is introducing hidden risks that you never signed up for. In fact, the advisors in our source material say they are very, very likely to fire a manager for this, even when their performance looks absolutely incredible. This brings us to the next really common myth, a behavior that has probably destroyed more wealth than just about any other: the simple idea of chasing performance. You know, you hire the managers who have done well recently, and you fire the ones who have struggled. Seems logical. But that strategy flies directly in the face of one of the most powerful forces in all of finance: mean reversion. The basic idea is that nothing lasts forever. Things tend to circle back to their average. So today's superstar manager is very often tomorrow's underperformer, and, vice versa. And this leads to what our source calls the typical mistake. We get impatient after a couple of years of poor returns, so we fire the manager. But we're often doing it at the absolute worst moment, right before their strategy is about to pay off. And then we go and hire a new manager who's probably at the very peak of their own cycle. Professionals, they're playing a completely different game. They operate on a timeline of a full market cycle, which could be 3, 5, even 10 years long. Underperforming for a few years is not only expected, it's tolerated. The real judgment only comes over the long haul. And if you want a cautionary tale, look no further than this story from the source. Back in the late 90s, an endowment got frustrated with its cautious advisor, so they fired them, piled into all the hot.com stocks, and ended up losing 65% of their capital in less than 2 years. Just a brutal, unforgettable lesson in the price of impatience. Okay, so now we come to the final and I think the most profound myth. This one gets really deep into the psychology of the whole advisor-client relationship, and it reveals this fascinating kind of hidden conflict of interest that exists even with the most honest advisors out there.
So let me ask you this kind of provocative question. Do you believe your advisor invests your money in the exact same way they invest their own? We'd all like to think so, right? But the reality, as our source shows us, is a lot more complicated. This slide shows this fascinating confession from the lead advisor in our source text. For her own money, she's extremely defensive. She holds assets that have performed horribly, and she's totally willing to underperform for years. But for her clients, she recommends a more conventional, stock-heavy portfolio. So what's going on? Is she being dishonest?
No, the conflict here isn't about malice, it's about psychology. The advisor knows that the theoretically best portfolio, the one she owns, will go through long, painful periods where it doesn't do well. And she also knows that 99% of clients just don't have the psychological strength to stick with it. They will panic and sell right at the bottom.
This quote from a client in the book just says it all. An advisor's main job isn't to create the portfolio that's best on a spreadsheet. It's to create the best portfolio that the client can actually stick with when things get really tough. And that is a profoundly different goal. So, after busting all these myths, what should we actually do? Let's take all these professional insights and put them together into a clear, actionable framework you can use to guide your own thinking. Here are the 5 key steps. 1. Stop focusing on quarterly results. They're just noise. 2. Evaluate over a full market cycle. Think in terms of years, not months. 3. Always ask how a return was made, not just what the number is. 4. Practice patience. It's a superpower. And 5, and this is the most critical one, know yourself. Be brutally honest about what you can truly stomach. And this really brings us to our final, crucial thought. Understanding all these principles, that's the easy part. The hard part is having the discipline to stick to them when your emotions are screaming at you to do the exact opposite. You have the professional playbook now. The real question is, do you have the discipline to use it?
So how does some of the wealthiest families in the world manage to beat the odds and hold on to their fortunes not just for a few years, but for generations? Well, we're going to break it down.
You know, it all comes back to this one old saying, a phrase that kind of haunts wealthy families everywhere. Shirt sleeves to shirt sleeves in 3 generations. And the idea is pretty simple, right? The first generation makes all the money, the second generation gets to enjoy it, and by the time the third generation comes along, poof, it's all gone. They end up right back where their grandparents started, in their shirt sleeves.
But here's the big question. Is that just the way it has to be? Is it inevitable? Or is there some kind of blueprint, a set of rules families can follow to protect their wealth for the long haul? That is exactly what we're going to get into.
To understand the solution, you first have to understand the problem. And believe it or not, the fundamental force working against any family's fortune has a name: entropy. Yeah, it's a concept straight out of physics. It's the natural tendency for everything to move from a state of order to, well, disorder. And it applies to a family's capital just as much as it applies to the entire universe.
So if you're literally fighting a law of the universe, you're going to need a seriously strong plan. The solution, it turns out, is all about building 4 essential pillars. Think of these as the foundation you need to create order and fight back against all that financial entropy.
And here they are, the 4 pillars of generational wealth. Number 1, education. Number 2, strategy. Number 3, governance. And number 4, values. Let's walk through each one and see exactly how this whole blueprint comes together.
Okay, let's kick things off with our very first pillar, investing in education. Now this one comes with a really fascinating little problem, something our source material calls the priceless paradox.
So here's the paradox, and it's a huge psychological blind spot. On one hand, everyone agrees that educating the next generation about how to handle money, how to invest, it's priceless. It is the key to not losing everything. But, and this is the crazy part, when families find out what it actually costs to get high-quality financial education, they almost never do it. The price tag, right here and now, just seems to outweigh that abstract long-term benefit.
So if those formal, expensive programs are off the table, what's the alternative? Well, it turns out the single best education is also totally free. It all comes down to active participation. Family members have to show up to the investment meetings. They need to ask the so-called dumb questions. They need to be a little skeptical, get involved, and just soak up the language over time. Look, it's definitely hard work, but it is the most powerful way to build that intellectual capital that's going to protect the family down the line.
All right, on to pillar number 2, adding strategic value. And I gotta tell you, this is about so much more than just trying to pick the next hot stock or finding some genius fund manager. It goes way deeper than that.
In fact, if you look at this list, manager selection is just one of 7 key areas where you can add real value. The actual work, the important stuff, involves everything from that super high-level asset allocation and tactical positioning all the way down to the nitty-gritty of rebalancing your portfolio and managing your taxes.
And let's talk about that first point, asset allocation, because this quote is just perfect. So often, families will see the amazing success of a big endowment like Yale's and they think, hey, let's just do what they're doing. But the advice here is crystal clear. Don't do it. Your family's needs, your timeline, your risk tolerance, it's all completely different. You're not Yale. You need a custom strategy built just for you.
You know, this really gets to the heart of a huge mistake people make. We tend to think that picking a manager is all about finding some genius who's going to hit it out of the park. But the real goal is actually defensive. It's about finding competent management, someone who is predictable, and, most importantly, someone who won't make a huge, catastrophic mistake that could really hurt you. Okay, our third pillar actually builds right on top of that last one. It's all about establishing smart governance, and the key tool for that is often something called an advisory committee. So what in the world is a family investment committee? Well, think of it as a small group of thoughtful, trusted people. And here's the absolute most important part. Their job is to give advice. They're a sounding board. They are not there to have authority or make the final calls. That power always stays with the family.
And it's really important to get that a family committee is nothing like what you'd see at a big institution. A huge company can go out and recruit these top-tier investment pros and give them real authority. But a family should build an advisory committee from its trusted circle. We're talking about their longtime lawyer, their accountant. The goal isn't to get Wall Street star power, it's to get sober, trusted advice.
And that brings us to our fourth and final pillar, aligning with values. Now, in today's world, this conversation almost always revolves around the rise of what's called socially responsible investing, or SRI.
And this is a big one. This can create a major divide inside a family, especially between generations. It all boils down to this one question. Can you invest for both profit and for purpose? How you answer that can cause a whole lot of tension.
So you have the traditional view, which is captured perfectly by this quote from Ned Titan. He sees himself as a trustee, and his number one job, his fiduciary duty, is to make as much money as possible for the family. So for him, the idea of accepting a lower return just to, quote, make the world a better place, well, that feels like he's failing at his most important job.
But then you have the next generation's view, voiced here by Ellen Titan. And for her, it's not just about the numbers on a spreadsheet. It makes her genuinely uncomfortable to think that her family might be profiting from companies or industries that just don't align with her values. It's a totally different way of looking at the purpose of wealth.
All of this debate, this generational push and pull, has led to a much more structured way of thinking about this stuff, and it's called ESG investing. It basically gives you a clear framework for looking at investments based on 3 key factors: their environmental impact, their social practices, like how they treat their employees, and their corporate governance.
So let's wrap it all up. There they are, the 4 pillars you need to fight that entropy and keep capital safe for the long run. Investing in that priceless education, adding real strategic value beyond just stock picking, building smart governance to get good advice, and finally, aligning your investments with your family's values.
Which brings us right back to that question from the beginning. When you look at this blueprint, is the capital that you care about protected by these 4 pillars? Or is it maybe just one generation away from ending up right back in shirt sleeves? Welcome to The Explainer. You know, when we think about wealth management, our minds usually go straight to stocks and bonds, right? The numbers. But today, we're going beyond the portfolio. We're going to explore the conversations that happen after the spreadsheets are put away, the really deep discussions about what wealth truly means.
Because for the world's wealthiest families, the biggest challenges, the things that keep them up at night, often have nothing to do with the markets. They're grappling with these huge questions of purpose, legacy, and their place in the world. So let's dive in and see how they try to figure it all out.
See, once a family's capital is secure, the whole game changes. The journey shifts from the technical world of numbers and returns to the deeply personal world of values and, well, what it all means.
We're going to follow this journey through 5 key stages, moving from the super practical to the really philosophical. And we're starting with the absolute foundation. How do you build a fortress to protect what you have?
Right. Before you can even think about growing wealth, giving it away, or passing it on, you have to make sure it can't just, poof, disappear overnight. And this is where the role of a custodian is, frankly, non-negotiable. Now, this might sound like a pretty simple, almost boring bookkeeping role, right? But it's actually a critical safeguard that separates the people making the investment decisions from the money itself. So why is that separation so incredibly important?
Well, this quote just cuts straight to the chase. Without a custodian, you're trusting your investment manager to both advise you and hold your money. That's a massive conflict of interest. A custodian acts as a firewall. So when your manager says, hey, let's buy Google, the custodian bank is the one that actually executes the trade. But your money never, ever leaves your secure account.
And this illustrates that key difference perfectly. Over on the left, with a bank custodian, your assets are walled off in their own private vault, so to speak. If the bank goes under, your stuff is safe. But on the right, at a brokerage, you're often just relying on insurance. And in a real, widespread crisis, having those segregated assets provides a whole different level of safety.
Okay, so the assets are secure. Check. The next conversation is all about structuring them for future generations. And one of the most common tools for this is something called a family limited partnership, or FLP.
Now, FLPs are great for pooling family assets so you can get access to top-tier managers. But the feature that gets all the buzz is a really clever valuation strategy that can slash taxes when you're gifting to family. It's often called the double discount.
So here's how it works, and it's pretty wild. First, you take an asset that's hard to sell, like a stake in a private building, and it gets valued at a discount because of that. Then you put that asset inside an FLP, which is also a structure that's hard to sell, and bam, you get to take a second discount. The result? You can give shares of that FLP at a much, much lower valuation, which minimizes those steep gift taxes. As you can imagine, the IRS watches this technique very, very closely.
With the wealth protected and structured, the conversation turns to purpose. And for many, that means philanthropy. But let me tell you, giving money away effectively is so much harder than it looks.
This one number, just 5%, creates this immense pressure. See, private foundations are legally required to give away, on average, at least 5% of their endowment's value every single year. This creates a constant, urgent hunt to find worthy causes, which, as you can imagine, can sometimes lead to rushed or even poor decisions.
This quote from the source material is just, wow. It really captures the core challenge. The world is a complex system. Good intentions are not enough. Your philanthropic efforts can have devastating, totally unintended consequences. Giving money away is easy. Giving it away wisely is one of the hardest things anyone can do.
Sooner or later, the question of legacy turns to the next generation. And this is maybe the most personal, most difficult conversation of all. How do you pass on wealth without ruining the character and the drive of your own children?
Okay, so one approach is what you could call the hard cap. The parents set a very clear limit. $100 million is obviously a life-changing amount of money, but it sends a powerful message that the vast majority of the family fortune is meant for a broader philanthropic purpose, not just for building a dynasty.
This next strategy ties the inheritance directly to the family's values. The children who prove they're the most responsible stewards of capital by giving it away thoughtfully are the ones who get entrusted with more of it. It makes it less about entitlement and more about earning the role of philanthropist.
And then there's this third approach, which is just fascinating, the character review. Here, the inheritance isn't a fixed number, it's dynamic. And the craziest part is, the children have no idea it's even happening. Every 5 years, the parents quietly review their kid's character, and if they like what they see, they increase the amount in the will.
Ultimately, when you look at all these strategies, they all point to the same conclusion. By the time most people inherit money, their character is pretty much already formed. This suggests that a parent's most important job isn't managing an inheritance, it's raising good, responsible kids in the first place. If they get that right, the money itself probably won't be a corrupting force.
All right, for our final section, we're zooming way out. We're going to look at the most outward-facing conversation of all. What is the role of a wealthy family in a world that is increasingly anxious and vocal about economic inequality?
The standard way we measure inequality is the Gini coefficient. A lower score means more equality. But as the source material points out with an absolutely brilliant analogy, a better Gini score isn't always the real goal. Just take the Chicago Bulls. In the 80s, the players had pretty equal salaries, a low Gini coefficient, and the team was mediocre. But in the 90s, their Gini coefficient went through the roof, making them highly unequal. The reason? One guy, Michael Jordan. His massive salary skewed the numbers, but he made everyone, his teammates, the owners, the city, the fans, immeasurably better off.
The source argues this exact same story is playing out in the global economy. Globalization has basically created a worldwide market for the Michael Jordans of every field, driving their pay way up. But at the same time, it puts lower-skilled workers in direct competition with billions of others around the globe, which holds their wages down. And that creates a growing gap.
Which leads us to this. The ultimate question the family in our source material asked themselves. It cuts right through all the financial planning, all the tax strategy, to the core moral question of our time. In a democracy, how is massive generational wealth justified? There is no easy answer. And it's that question that hangs over every single one of these conversations, leaving all of us with something to really think about.